Greetings, everyone. This is Thomas from the Klein Fund, and today we're back with Fundamentals of Financial Statements Part 2. Now, as entrepreneurs, one of the most critical skills you can develop is the ability to read and understand key financial documents, particularly the profit and loss statement and the balance sheet. These documents are essential tools for measuring the health and performance of your business, and they provide you with the data needed to make informed decisions that can drive growth and sustainability of your startup. The profit and loss statement, also known as the income statement, provides a snapshot of your business's revenues, expenses, and profits over a specific period. By analyzing the profit and loss, entrepreneurs can quickly access whether their business is generating enough revenue to cover operational costs or if adjustments need to be made in pricing, cost management, or marketing efforts. A strong understanding of this statement allows you to identify trends and evaluate profitability and make proactive decisions to improve financial performance. On the other hand, the balance sheet offers you a snapshot of your company's financial position at a particular point in time. It outlines the business's assets, liabilities, and equity, giving you a clear picture of what your company owns versus what it owes. By understanding your balance sheet, entrepreneurs can gauge the company's liquidity, solvency, and overall financial stability. This is critical not just for managing day-to-day operations, but also for making strategic decisions like seeking funding, managing cash flow, or preparing for growth. Without a clear understanding of these financial documents, entrepreneurs risk making decisions based on incomplete or inaccurate information, which can lead to poor financial outcomes. Ultimately, mastering the profit and loss statement and balance sheet empowers entrepreneurs to plan for a better future, avoid common financial pitfalls, and steer their business towards long-term success. Now, in Fundamentals of Financial Statements Part 1, we examine the profit and loss and balance sheet in the manner of taking raw data and building out these two financial documents. So we got to see the mechanics of how a balance sheet and a profit and loss statement work. But today, we're going to examine the profit and loss and balance sheet from a bit of a different perspective. Today, we're going to look at these financial documents from the perspective of a business owner who's trying to make decisions. And we're also going to examine it from the perspective of a banker who's trying to decide whether to approve or deny a loan application. Now, with regards to the business owner, perhaps the biggest benefit to be had is that it gives you the ability to make data-driven decisions. And this is very, very important. There is really no room in business if you are attempting to take your business to the highest level to be relying upon gut feeling decisions without seeing any data. This is a dead end road. You may get lucky a few times making decisions based upon your gut, but over the long period, it is a strategy that is destined for failure. And so with the hard concrete evidence provided to the business owner by the profit and loss statement and the balance sheet, you immediately unlock the ability to make financial decisions at the highest level. Next, another big benefit that a good understanding of these financial documents provides the business owner is the ability to manage risk. Identifying signs of financial distress early on, when you do that, you have the ability to make adjustments before the problem magnifies. And when you're keeping a consistent look on your financial statements, if you're paying close attention, you will be able to identify these areas of distress early on. And that is so much easier to address. than a problem that you don't uncover until it's late stages, because by then the number of tools that you have at your disposal to address that problem is greatly diminished. So early identification of risks is something very important that financial documents provide us with as business owners. Um, Identifying profitability is another big issue. And um, that may seem kind of obvious, but it's really not, because your business may be profitable overall on your monthly statements, on your profit and loss statement. But it could just be that one area of the business is lacking profitability. Many businesses offer a diverse set of products and services, and not all of those products and services are always going to be profitable. And so when you can identify which areas of your business are profitable and which areas are not, then you can go about making decisions to address those issues moving forward. Maybe it's the fact that maybe a certain product or service is not profitable because you're not allocating enough resources to that product or service to make it profitable. Or it could be that that product or service was just perhaps well intentioned, but it didn't produce the kind of results when we put it on the market that we had hoped for, and maybe it just needs to be taken out of your line of products and services altogether. Um, so identifying profitability is more nuanced than you may imagine, and consistent reviewing of a profit and loss statement can help you identify those nuances and address them early on. Um, and directly related to profitability is the ability to plan for your taxes. Um, Financial statements provide crucial data for tax filings, and by analyzing these statements, business owners can plan for tax liabilities and take advantage of any deductions or credits available, and minimize their tax burden. You know, all business owners love to see their business producing profits. We would all prefer if they produce profits all year long. But one thing that profitability leaves us with is a big tax burden. Perhaps not a big tax burden, but a tax burden. The bigger the profit, the bigger the tax burden. And so, understanding where your profits are at late in the year, you can make moves to reduce that tax burden by adding assets to your company. So, if you've made a $60,000 profit in the year, you're going to end up paying a decent proportion of that to the IRS in taxes. But let's just say you happen to also be in need of a piece of equipment, and that piece of equipment costs $50,000. Well, you can purchase that piece of equipment, deduct that entire $50,000 off of your revenue, which would leave you with a $10,000 profit for the year, which would leave you with a much smaller tax burden at the end of the year. So, in just a few short minutes, we've described many crucial benefits to properly understanding your financial statements as a business owner. But then we're also going to examine uh, these financial statements through the perspective of a banker who's, considering a loan application. And so when a banker is making these considerations, there's certain things that they're looking for in these financial documents. And perhaps the most important thing they're looking for is profitability. Banks are not going to lend money to a business that is, year after year showing a loss, because banks want to get paid back when they lend money. And if you're consistently losing money, that can only happen for a certain amount of time until the business goes bankrupt. Um, Bankers want to see that a business is consistently profitable or has the potential to become profitable in the near future, because a business with strong cash flow is much more likely to meet its loan repayment schedule. So profitability is something that your financial statements can demonstrate to a banker, and show them the numbers that they want to see. Now, um, another thing that they're going to be looking at is cash flow. And just because your business is profitable doesn't mean you're always going to have a favorable cash flow. Sometimes businesses, um, their cash flow gets diminished as a month goes on because so much of their money is collected at the end of the month with accounts receivable. So just because you're profitable doesn't mean your cash flow always works in an ideal manner. And from a banker's perspective, positive cash flow indicates that a business has enough cash to pay its bills, including its debt obligations. And a business with strong cash flow is much more likely to meet its loan repayment schedule. Um, and so then another thing that the bankers are going to look at when reviewing your financial statements are the company's debt levels. Every company has uh, a maximum debt that they can afford to service. And after you reach that point, then the cash flow is not going to be there to keep servicing debt. And so bankers are very, very aware of this. And um, the banks will review the balance sheet to determine the amount of debt a business has, and high debt levels can signal financial strain and make it more difficult for the business to take on additional debt or meet its current repayment schedules. They specifically look at current liabilities and long-term liabilities to make these decisions and analyze debt levels. Liquidity is something else that they're going to be looking at. Liquidity shows whether a business has enough assets available to cover its short-term obligations. And in a strong liquidity position reduces the likelihood of default on a note. So liquidity is very similar to cash flow, but there are some nuanced differences there. And lastly, the banks are going to look at a company's equity position when making a decision on approval or denial of a loan. The balance sheet will show the owner's equity, or the difference between the total assets and total liabilities. Bankers look for a solid equity position, indicating that the owners have invested significant personal capital in the business. And a higher equity position indicates a lower risk to the lenders. And a well-capitalized business with substantial owner's equity is seen as more stable and less likely to fail. So that's a look at what the bankers are going to be looking at generally, when they review your financial statements for approval or denial on a loan application. And so then we're going to start by looking at the profit and loss. And so very briefly, what is a profit and loss? Well, first, it's important to know that profit and loss has a few different terms that it can go by. When I first started learning accounting, we didn't refer to it as a profit and loss statement. We referred to it as an income statement. And over the past 20 years, it's kind of evolved into the profit and loss, and less people refer to it as an income statement. But it also goes by statement of earnings or statement of operations. So if you hear any of those terms, those are all referring to what we now call the profit and loss statement. And basically, what the profit and loss is a summary of a business's revenue and a business's expenses over a select period of time. Generally, we look at profit and loss statements on a monthly basis, but we can also look at profit and losses quarterly, and we can also look at them annually. And it just depends on what type of data we're trying to analyze, you know, when we make these statements out to be either monthly, quarterly, or annually. We're trying to make different decisions, so we will pick a different time frame to examine. Um, and that's in a nutshell what a profit and loss statement is. So then, the purpose of the profit and loss, what does it actually do? Well, um, in a very basic sense, a profit and loss is a report card of your company's performance over a specific period of time. It that's what it does. That's what it is. It lets you know how things are going inside the business, financially speaking. It's also a tool that allows you to monitor and compare productivity, growth, and opportunities. Um, Profit and loss is a means to make informed decisions, as we've already stated, regarding expenses, the effectiveness of strategy, and profitability. Um, and perhaps one of the most important uses of the profit and loss is that it's a vehicle for change and cementing proven, efficient operational processes into your business. Um, you know, as we started off saying that the biggest benefit that a profit and loss does is to allow a business owner to make data-driven decisions. And when things aren't going well in a business, um, usually the profit and loss statement is a great way of identifying where things are going wrong. And when you are able to identify these problematic areas with hard data, then that makes change a lot more. Um, it takes a lot of the risk out of change. You don't want to be making changes again based on a gut feeling. We want to know why something happened and what we can do to address it. And so, having that data as a vehicle for change is a highly effective way of righting the ship. The ship being your business. And it's also one of the single most powerful ways someone can see and assess your operations from the outside in. So, if you were looking to take your business to the next level, you bring in an industry consultant to give you ideas about how to get your business to that next level. One of the first things they're going to want to do is have a look at your financial statements. Um, they're going to ask a lot of questions about the business, but all of those questions and all of those answers generally are backed by what the financial statements say is happening within the business. Um, Now, despite all of this and the volumes of useful information it contains, it's often underutilized or not utilized at all by the small business owners. Um, and, generally speaking, in the world of small business, you have a person that has a trade and they're very good at that trade. So they decide to start their own business. But it's after they start the business that they realize that being proficient in that trade doesn't equal running a successful business, because running a business is almost a trade in and of itself. And so you have this person who is skilled in their trade. um, they decide to go out on their own, but it's going to take them a period of time to understand all of the nuances of running a business, all of the different buttons you can push and levers you can pull to affect change in different ways across the business. Um, but thankfully, it's easy to start using and to understand. So let's go ahead and take a look at the profit and loss statement and what it actually looks like. So this is a sample of a very, very simple profit and loss statement, probably one of the most simple profit and loss statements that you'll ever see. There's not a lot of data here, but I designed it this way um, in order to make simple points about things. We don't want to have to dissect a very complex financial statement here. This is all about the basics. So this financial statement is 100% fabricated, but this is what almost any financial statement or profit and loss statement should look like. So up at the top, you'll see the business's name, address, and phone number, and you see it labeled as a profit and loss statement, and it has the dates for which the profit and loss is contained within. So this profit and loss is looking at the year of 2023 from January 1st to December 31st. Next, if we look up at the top, we'll see income. We see sale of goods, sale of services. These are broken down. You could further break these down by the type of goods and the type of services. But again, for the sake of simplicity here, we just kept them all in, goods and services without doing the breakdown. Next, we have cost of goods sold. Cost of goods sold relates to your sale of goods. If your goods are a t-shirt and you sell your t-shirts for $20 and you buy those t-shirts for $10, then your cost of goods is $10 per shirt because that's what it cost you to purchase the shirt. So your cost of goods gets deducted from your total income, and that leaves us with gross profit. And below that, we have our expenses. Now, this particular business only has a few expenses: advertising, office supplies, and wages. Now, we all know that businesses are generally going to have many more expenses than that. But again, for the sake of simplicity, we just kept it at 3. And then all the way at the bottom, we see our net income. And this is where our profitability is. So we take our gross profit, we subtract our total expenses from that gross profit, and that leaves us with our net income. As we can see, this company has a $82,500 profit for the year of 2023. So on to the next slide. So this is the same profit and loss we were just examining. And now let's take a moment to review what the profit and loss is saying about this business. So with regards to income, we can see that we have $450,000 in sale of goods, and we have $115,000 in the sale of services, for a total income of $565,000. Now, if we break that into percentages, we know that the sale of goods is 80% of your revenue, and the sale of services is 20% of your revenue. So right there, we right off the bat know a large majority of our income is coming from goods rather than services. And that may have large implications with regards to the way we market or the way we purchase inventory or a number of things. So just simple data right there gives us very, very key indicators. Now the expenses, the wages on this profit and loss was by far the largest expense. It represents 95% of the total expenses, and it eroded 74% of the gross profit. That's a big deal. That's a large percentage of a company's income being, taken over by wages. Now, that may be common in this industry. It may be uncommon, but it's important to know. And again, this is where the profit and loss is telling us things that we may otherwise not have known if we had not put this on paper and looked at it. The other business expenses only totaled 18% of your profit margin. So we can see that by far we spend more money on wages than anything else. And that's something that you always want to have top of mind, and you want to have a frame of reference for what that number should be. And then, overall the business was profitable, but your total profit was 15% of the total revenue. So is that good or is that bad? Again, it depends. It could be a good thing, it could be common, or it could be a bad thing. It just depends on the industry, the size of the business, the location. These are all factors that go into that. And so moving forward, what does all of this mean? So let's take a moment to reflect and think about the data that we have just discussed. Um, with this data, would we say that the business is successful? Is the capital being spent wisely? Are your employees productive? How will others look at your business? How will this impact your present and future decisions? Um, you can't answer any of these questions if you're not actively managing your profit and loss statement, comprehending the numbers that are on there, taking notes, and understanding the inner workings of your business. Without the comparative data gain, you may miss important information and trends. And I know I've met so many people over the years that have a small business, don't put a lot of stock in their profit and loss. And it's usually because they feel like they are able to manage all of this in their mind. Um, and I've seen that be a failed strategy so many times. It's not even something that I would consider doing anymore. Um, it's a proven failure of a strategy, and that is why we are doing this presentation today, because you need to understand how important this data is to the success of your business. Now, a small business owner will look at these results periodically and make educated decisions based on what they're observing. Um, you know, Seeing something and then reacting to that thing that you saw, um, that can only happen when you are are involved with and managing and comprehending your financial statements. Otherwise, you're just going off of feeling. Um, and as I've said many times, that is generally a failed policy. So let's see that in action by looking at the previous year's profit and loss, and putting it next to this and seeing what it tells us. So we're going to start with income. Now, briefly, we can see 2023's income. Sale of goods was $397,000. Sale of services was $110,000, and total income was $507,000. Fast forward to 24, we see improvements all across the board. So the sale of goods in 2024 jumped from $397,000 to $450,000. The sale of services jumped from $110,000 to $115,000. And the total income rose from $507,000 to $565,000. So, we're seeing growth across all of our income, which is a good thing, right? Um, it depends, but generally speaking, we have to look deeper to really understand what is going on with the business. Now, with just a look at income from 2023 to 2024, probably the first thing that many business owners are going to say is, I'm happy. I'm showing sales growth of about 10% year over year. Um, the growth is also in both of my business's income streams, which I think is a good sign. And I should make sure I continue with my strategy because it's yielding results. Um, Again, this is only taking into consideration income. And as we know, there is more to a profit and loss statement than simply income. Now, the banker is going to look at this profit and loss, this income portion of the profit and loss, a bit more skeptically. He will acknowledge that the business grew over the past year, which is a good sign, but he's going to need to see more of the data. Um, Gross income is important, but I really need to know how profitable the business was. And I wonder if this is consistent for this business. Um, and so we see the business owner leaning heavily on the growth of revenue from 2023 to 2024. We see the banker acknowledging this growth in revenue, but understanding that growth in revenue does not tell the tale of success or failure in business. There's a lot more data that needs to be comprehended. So let's move forward, take a look at some more data. So now let's take a look at expenses from 2023 into 2024. For expenses, we can see total in 2023, our expenses were $224,000. And in 2024, $295,500. So we saw our expenses grow at a rate of 25% year over year. Now, again, we're going to look at this from the business owner perspective and the banker's perspective. The business owner may look at these numbers and say, I increased sales, but I also spent more money. He may think to himself, I hired someone new, the other employees like them, but payroll is getting kind of expensive. He may say, I doubled my advertising budget, but definitely did not double my sales. So am I spending my advertising dollars wisely? Is it effective? And he also may question, did I overspend? Am I getting good value out of the additional investments into the business? But then conversely, the banker is going to have a different perspective. He's looking at it saying, whoa, expenses are up considerably. 25% is a lot in 1 year, especially when revenue only increased 10%. So we see lopsided distribution of growth. And that's something that, the banker is going to be concerned about the usage of working capital. And with a 25% increase in expenses, I hope they can justify that with their profit margins. Again, I wonder if this is consistent for this business, because you can't look at all businesses, even if they're all in the same industry, as equals, because different businesses are set up with different purposes in mind. And so the key thing is to see consistency with regards to the organization that you're examining. And so let's take a bit of a deeper dive into this and compare the profitability of the company for 2023 and then for 2024. Now, if we take a look, net profit is down 36% in 2024. But if you recall, the overall revenue for 2024 actually increased by 10%. So how did we get an increase in sales of 10%, but then a net profit that is down about 36%? How does that happen? Well, from the business owner's perspective, that individual was likely to think, I spent more money and made less money. Why did that happen? They might think, I hired someone new. Perhaps maybe I did it too soon. I doubled my advertising budget, but was that advertising effective? I'm concerned about next year. Maybe I need to borrow money because my profits are dropping from 2023 to 2024. Something is wrong. I was expecting profits to increase much more. Now, the banker is going to look at it from a different perspective. The banker might think, well, this business was profitable, but is slowly showing a downward trend for profitability. Even though the business increased in sales, they're showing they can actually afford less than they could last year. Between the increasing expenses and decreasing profit, I'm very concerned for the future of this business. They might think, I'm concerned that if this trend continues, they won't be able to afford more debt. And lastly, they might wonder, I wonder if this is consistent for this business. Consistency is the key. It is likely too risky to lend to them. We see revenue going up. We see expenses going up at an even quicker rate. And because of that, we saw profitability drop from 2023 to 2024. Now, if we didn't consider the holistic view, and if we only looked at the revenue comparison for 2023 and 2024, things would appear to be going better. I mean, you know, the revenue increased 10%, but we've seen that that is actually not the case. When you have expenses increasing at a quicker rate than revenue is increasing, that's going to lead to bad outcomes over the long term if nothing is adjusted. And so that's the two different perspectives, one being a business owner, one being a banker, and how they may view the same set of data. Because the business owner is trying to figure out, what buttons am I pushing that are not correct? What levers am I pulling that are not correct? And the banker is looking at it like, well, they're profitable last year. They're not as profitable this year. We see the trends in their expenses. If we loan this company money right now, 3 or 4 years down the road, we may run into issues. So it's not all about what they can afford today. It's what trends are occurring in the organization. What does it appear that they can afford over the long term based on the way things are currently trending? So it's a bit more nuanced than we may think. So to wrap up the P&L, this review and comparison was entirely fictitious, but also entirely plausible. On many occasions, business owners make decisions without taking into consideration all available data and end up surprised by the results. And as I said just now, you have to consider all data. Just a simple comparison of revenue between 2023 and 2024 wouldn't have told us what's going on. We had to look at the revenue, we had to look at the expenses, we had to look at the net income and take a holistic view of everything. So in this scenario, the business ended up less profitable due to an increase in expenses that were ineffective, premature, or need more time to produce results. So we can clearly see here the value of the profit and loss statement. And as a business owner, making decisions should always be tied back to the information that you have at your disposal. You should be ready to pivot if capital investment is not yielding expected results. We should use the data to establish trends and anticipate results. We should keep in mind that a typical P&L will have a lot more detail in each category, and we should understand what those details mean for the business as a whole. And we should also keep in mind that this is the report card for your business. This is your performance review, and you get it on a monthly basis. And it's extremely beneficial to review these on a monthly basis. You should know it inside and out, and you should use it to identify the strengths and weaknesses in the business. So let's remember what the P&L is there for. It's there for assessing profitability. It's there for tracking business performance, for budgeting and forecasting, for decision making, for tax reporting, for investor evaluation, and of course, it's there for applying for a loan. So that's the P&L. Next up, we're going to take a look at the balance sheet. So what is a balance sheet? A balance sheet is actually a quite simple document, although they can appear to be extremely complex for larger companies. But for our concerns, we're talking about startups and small businesses, and these types of organizations generally have fairly simple balance sheets. And so the balance sheet is a summary of the business assets, the business liabilities, and the business equity. And as opposed to the profit and loss, which is taken over a specific period of time, like the period of a month, the period of a quarter, the period of a year, the balance sheet is taking a snapshot of what the company looks like during one specific period of time, whether that be the end of the month, the end of the quarter, or the end of the year. And so getting into balance sheets, there are some vocabulary that can help us along in terms of understanding everything the balance sheet has to tell us. And so, assets. What are assets? Assets are a company's resources, such as cash, inventory, accounts receivable, investments, lands, building, equipment, etc. Um, Assets are fairly self-explanatory. Liabilities is what you owe on an asset. And so if we borrow $50,000 for a piece of equipment and we put $10,000 down, then we have a $40,000 liability on day one of owning that equipment. And now that's opposed to equity, which is the amount on those assets that you have already paid for and now own. So with that same example, if we have a $50,000 piece of equipment, we have $10,000 that we put down on it. We're still going to have that $40,000 liability, but we also have $10,000 of equity in that asset because we have paid $10,000 of the total $50,000 price tag. So I hope that clears up the difference between liabilities and equity and how they relate to assets. And the equation for balance sheets is always going to be the same. Assets have to equal liabilities plus equity. And we can go right back to our $50,000 piece of equipment. If you paid $10,000 down, then your equity is going to be 10,000 and your liabilities is 40,000. So 40,000 plus 10,000 has to equal the $50,000 that the asset cost up front. So assets will always equal liabilities plus equities. And if it does not, then you have made a mistake somewhere in your balance sheet, somewhere in your accounting software, you've entered the wrong data, somewhere, somehow, some way you've made a mistake, because the one hard and fast rule for balance sheets is that assets have to always equal liabilities and equity. Now, we can break these terms down a little bit further with regards to how they apply to the balance sheet. With assets, we have current assets, and current assets are assets expected to be converted into cash or consumed within 1 year or within the company's operating cycle. So examples of current assets are cash, accounts receivable, inventory. These are things that either are cash or are quite generally converted into cash in a fairly short period of time. And that's opposed to long-term assets. And the definition of long-term assets are assets that are expected to provide economic benefits over a period longer than 1 year. So when we think of long-term assets, we're thinking about plants, we're thinking about properties, we're thinking about equipment, we're thinking about patents. The list goes on and on, but this gives you, these few examples gives you an idea of what we're talking about when we're talking about long-term assets. When we buy a plant, when we buy property, when we buy a piece of equipment, when we purchase a patent, these are long-term investments. We're not planning on converting these back into cash anytime soon. We are going to retain ownership of them and use them for economic benefit far out into the future. Now, on the liability side of things, we have current liabilities, very similar to current assets, but um, a liability instead. A current liability is an obligation that obligations that are due to be settled within 1 year or within the company's um, operating cycle. And so examples of current liabilities would be accounts payable, wages, taxes payable, dividends, etc. And so we can see the similarities between current liabilities and current assets. With current assets, we're going to convert those assets into cash in a relatively short period of time. With current liabilities, these are liabilities that we will pay off in a relatively short period of time. And that's opposed to long-term liabilities, which are obligations that are due to be settled after 1 year or beyond the company's operating cycle. And some examples of these would be bonds, pensions, lease obligations, etc. And it can also be, notes on a piece of equipment or things of that nature. These are things that are going to take us longer than 1 year to pay off that liability. And so hopefully that gives you a good understanding of the different types of assets and liabilities that can be seen on a balance sheet. And so the balance sheet's purpose, what does it do? Well, the balance sheet is quite important. The balance sheet of a company is a crucial tool for analyzing the value of a company's assets. Examining short-term and long-term debt can give great insight to a company's levels of risk and leverage. And the equity portion of the balance sheet tells you the net worth of the company, giving you insight into that company's equity position. And so, again, the balance sheet tells us what assets does this company have, how much of those assets does the company owe on, and how much of the assets does the company already own? How much money have they paid towards those assets? And so the equity position is quite clear from the equity portion of the balance sheet. And additionally, a company's balance sheet can give key insights into potential investors with regards to a company's financial resilience and ability to generate returns. And lastly, by comparing current assets to current liabilities, you can gain an insight into a company's liquidity position. So here is an example of a balance sheet. I did my best to include all of the different categories that we might see without making it too complex. So this is a pretty simple version of a balance sheet. So again, just like with the income statement, we see at the top the name of the company, we see their address, and we see their phone number. And always at the top of a balance sheet, we're going to have assets. And here we have those broken down into current assets and long-term assets. You see that our current assets are cash and inventory, and our long-term assets are property and equipment. So current assets plus long-term assets equals our total assets. And this company has total assets of $425,000. Next, we go down to current liabilities. And so with the current liabilities, we see this company has accounts payable and taxes payable. Then we have our long-term liabilities. In this case, we have a mortgage and notes payable on a piece of equipment. And so again, long-term liabilities plus current liabilities equals our total liabilities. And lastly, we have our equity. So we can see that we have owner's equity of $100,000 and we have notes paid of $10,000. So we have total equity of $110,000. So that's the basic setup of a balance sheet. And understanding what each of these categories are, and how they relate to the value of your business gives great insight into what your company's worth, how much more debt your company can handle, your liquidity, your solvency, et cetera, et cetera. There's so much valuable data that you can gain from the balance sheet. And unfortunately, it does get ignored a lot. So, what kind of insights can we take away from this balance sheet? Um, what are the chance of this company receiving additional financing from a lender? So, let's think about it. Now, it's quite easy to identify here that current assets is equal to current liabilities. So this company has 80,000 in cash and another 55,000 in inventory that could presumably be converted into cash fairly easily. Now they have accounts payable of $70,000 and taxes payable of $65,000. So like right off the bat, we can see that in terms of current liabilities and current assets, the company has a bit of a cash flow issue because accounts payable and taxes payable have to be paid, presumably within a 30 to 60-day window. And we've only got 80,000 in cash to put towards that. We would have to convert all of our inventory into cash to take care of the remaining balance on those current liabilities. And then if we do that, how are we going to purchase more inventory? Because all of our cash would then be exhausted. So the company's experiencing cash flow issues and may struggle to pay its monthly bills. In this comparison we've just done is called the current ratio, current assets divided by current liabilities. And generally speaking, a good current ratio is usually a range between 1.5 and 3. And we can see here that this company has a current ratio of 1, which is below the 1.5 threshold of what would be considered a good current ratio. Next, let's take a look at the company's debt. The company's debt is nearly 3 times its equity. So current liabilities, 135,000, long-term liabilities, 180,000. So we can look at this and identify that the company is financing its growth through debt, making it a bigger risk for investors. Now, we can look at what is called the debt to equity ratio, and that is the total liabilities divided by the total equity. Now, we consider a good debt to equity ratio to be between 1 to 1.5. And that is not even close to what we have here with this company. As we can see, the total debt, total liabilities, in other words, is 315,000. The total equity is 110,000. So it's more like a 3. And when we're looking at 1 to 1.5, so we can see that those numbers don't represent what would be considered a healthy debt to equity ratio. So then if we look at the current assets, current liabilities, long-term liabilities, all of these take all of the data available. We've examined the current ratio. We've examined the debt to equity ratio. We've discovered that neither of them fall into what we would consider a healthy ratio. That would bring us to the conclusion that based upon the data and the insights given to us by the balance sheet, it's unlikely that this business would be able to secure additional outside financing. It's just too risky. The cash flow issues and over-reliance on debt for its growth simply present too much risk. And that is insight we are able to gain simply from looking at the balance sheet. So anyone out here who is running a business and who are not sitting down on a monthly basis, a quarterly basis, an annual basis, studying these financial documents and hearing what they have to tell you, you're really missing a lot of opportunities to improve the effectiveness and efficiency of your operations inside your business. So I hope this presentation gives some insight into why financial statements are so important for business owners to understand, and why they need to sit down with them consistently and listen to what the financial statements have to say. Now, before we bring this to a close, I want to send a special thanks to Bob Boyer. He is with Silicon Harbor Business Services, bookkeeping for small businesses. His number is 843-972-9284, and you can reach him at rboyer@shbusa.com. Bob, thank you so much for putting together this presentation for us. Very well put together and really, really explained the points that we wanted to hammer home. So thank you guys so much for being with us today. Thank you to Bob for putting this presentation together. And we will talk to you next time on the Climb Fund Entrepreneurial Elevation Series. Thank you.